Good morning, ladies and gentlemen. You're warmly welcome to the 2026 edition of the Annual Economic Review and Markets Outlook webinar. This is the third edition of the event, and we are excited to have you join us for what promises to be an insightful and impactful session that will position us for investment success in 2026. My name is Isaac Oparinoi, and I'll be your host for this morning's session. Joining me today are speakers from our wealth management team in the persons of Mr. Peter Bewa, who is the Chief Executive Officer of Axis Wealth Management. Mr. Eric Corte is a wealth manager at Axis Wealth Management, and Gideon Amweniche is a wealth advisor at Axis Wealth Management. Together, they will put into perspective the dynamics of global investing. They will also share comprehensive economic and market analysis, and they also deliver projections for the year ahead. Each of them will have an allotted time to present, after which the remaining time will be dedicated to answering your questions. Should you have any questions during the sessions, kindly submit it using the Q&A tab and it will be addressed within the session. At this point, it is important to mention that the information shared at this webinar is for educational purposes only and does not constitute investment or financial or tax advice. Participants are advised to seek independent professional advice from an expert, like an advisor from the Axis Wealth Management team, before making any investment decisions. Without wasting much time, I would like to hand over to the first speaker in the person of Mr. Eric Corte, who will give us an overview of the operations of Axis Wealth Management. Mr. Corte, if you can hear me, please take over the mantle and take us through the operations of the Axis Wealth Management team. Thank you.
Thank you very much, Opari, for that beautiful introduction. And thank you very much, participants. It's always a pleasure to have you on our platforms. I'll set the ball rolling by sharing with you a brief on Axis Wealth and then proceed to share with us some perspectives about global investing. Chances are that if you're on this call, you are either a client of Axis Wealth already investing globally, or you are a prospect getting ready to join the happy family of global investors. Axis Wealth is predominantly a wealth management business that preserves and grows clients' wealth by using global assets. So it's important we set the tone for today's engagement by looking at some dynamics of global markets. Next slide. I want to start off by looking at this particular slide where we seek to selected some asset classes, and what we are seeking to do here is to look at how they've behaved over three distinct periods. So we'll be looking at the 1928 to 2025 period. We'll also look at the 1974 to 2025 period, and we'll also look at the 2016 to 2025 period. Now, a careful glance at this tells you one clear picture, that over the long run, the S&P 500 churns out the highest returns. And one key fact from this is the fact that when it comes to global investing, equities are the drivers of growth for you. Now, gold and real estate, we traditionally have known them to be what we term as store of wealth, and they have also performed fairly well. But then using only average returns as a proxy to understand global investing will not give you a fair and a full picture. So we want to see how the markets behaves under different economic circumstances. So we'd want to look at the same picture under a bullish market condition. Next slide. So during a bullish market, within using this same three distinct time frames, you still realize that the performance from the S&P is still very much elevated compared to the asset classes. Indeed, if you look at the three distinct periods, there's only one period that's outperformed the S&P 500. So the thesis that the global investment market reward equity investors still hold. Now, would also would want to examine what happens during a bearish market. Next slide. Well, so during a bearish market, this is a time when markets are not as active as a bullish situation. Now, equities basically act as a double-edged sword. In bearish markets, it churns out the worst of returns. And you also look at gold. Gold also follows closely, churning out some negative returns. And I'm sure what will surprise a lot of participants is that investment grade corporate bonds also during a bear market churns out negative returns. That tells you that even fixed income are not immune to negative performance during bear market. Real estate and gold, we've known to be traditional store of wealth, are also not immune from bear market. And for me, this is what I term as proper investing. Speaking predominantly to an African audience, we are a bit spoiled because of our use of mutual funds, where we use a lot more of amortization, and all we see are positive returns throughout our investing life. But even if you have a bond and you are not holding to maturity and you want to exit in between, there are chances of you losing a bit on your principal or capital, or having experienced some bit of capital appreciation as well. So those are some of the dynamics, and that is it. So this is what I term as proper investing, because the aim of you to invest is to grow your wealth, and more or less the trajectory up is not a straight smooth line up. So just let's have that at the back of our minds. You are definitely going to go up, but the ride is fairly bumpy. But for patient investors, the markets will reward you. The next slide. In terms of market cycles, we've really had a situation where we've had multiple years of strong performance. We've had multiple years of strong performance. Let me just we've really have had years of multiple performance. Now, if you look at a four periods here, you realize that in the 1927 to 1928, where we had strong performances, the third year turned out to be bearish. Now, would the only time we had 4 consecutive years of strong market performance was in the 1995 calendar year, 96, 97, 98, where we saw 37, 22, all the way down to 28% of strong market return. Now, the big question here is, are we going to see that again? Because in 2023, the markets produced very, very impressive returns, 26%. 2024 was a very strong year. I remember there was a lot of conversation as to what was going to happen in 2025, but yet we still saw a decent return of 16%. Now, the big question is, what is going to happen in 2026? And my colleagues would do just justice to that. Before I hand over the mic, I would just want to share some quick thoughts with you on bear markets and answer some questions I'm sure a lot of investors will have lingering on their minds, whether bear markets would erase their gains and all that. So, next slide, please. So, a bear market is defined as erosion of the indices by 20% or more. And typically, the bear markets last averagely for 14 months. Albert, next slide. The big question is, do bear markets erase your gains? And typically, you would have bull markets last on average 60 months with a return of around 165%. Bear markets barely last for about 14 months, and the decline will be just be around 33%. So the caveat is that for patient investors, for people who stay invested over the long period of time, your gains during your bull market days would ensure that you have a smooth ride during very, very difficult bear markets. I would also want to look at how our internal portfolios have performed over the period, and we'll look at the year 2025. So as I mentioned, one of the ways we help our clients is to grow, preserve and grow their wealth. And one of such means is to help them and allocate them to in-house, well-researched model portfolios. So we have our aggressive growth portfolio returning 14.6% in the year 2025. We have our aggressive growth portfolio with a focus on Europe, returning 19.23%. Our aggressive growth portfolio, excluding the USA, turned out with 32%. Our gold ETF portfolio turned out 64%. Pure yield portfolio did 1.18, and our satellite equity portfolio returned 29.28%. But I'll be the first to issue this caveat that past performance is not indicative of the future. But I mean, we do our best to ensure that we take the right investment decisions and give the right support to our clientele. At this juncture, I would like to hand over the virtual mic to my colleague Gideon Amweniche to take us through the rest of the presentation. Thank you.
Okay, thank you very much, Eric, and good morning to all participants on this webinar. I would want to begin by setting the context for our review of the economic and market performance in 2025 before I delve into the main presentation. So I think overall in 2025, the economic backdrop remained quite favorable for the markets. We saw that the economic backdrop was largely in line with most investor expectations. And so markets also reacted likewise. A lot of people entered 2025 with heightened fears around markets pulling back after 2 successive years of positive performance. However, most of these scenarios did not materialize. As a result of that, we saw most investor sentiments strengthening in the course of the year. We saw there were also quick recoveries during periods of volatility. And so people who stayed invested in the market last year, and particularly those who took advantage of the volatile periods, ended the period with quite a strong performance. With this context in mind, I would want to move on to the main content of this presentation, where we'll look at how GDP growth has performed over the period in 2025. I would begin by starting with the Euro area. And as we can see in the charts here, we can see that Euro area did record positive performance, but clearly the growth was subdued. We started the year around 0.6, but at the end of Q3, the latest print that came out was 0.3, which was significantly lower. And this was largely this positive performance was supported by the declining inflation in that region, which supported local or domestic demand, and that supported the positive growth. However, there was weak manufacturing activity and some structural headwinds bordering around labor shortages and some supply disruptions, which kept this growth subdued. I would move on to the emerging markets area, where the story is much more encouraging. If you look at the bar charts, you can see the gray bars are quite high, and we can also affirm that this was largely supported by domestic consumption or strong domestic consumption against some investment activities that took place in emerging markets. I think across board, most emerging markets benefited from the easing inflation, domestic consumption resilience, and then also I think one other thing that really supported was the improved financing conditions across emerging market areas. That largely drove the performance we saw. Now, I'll turn to the United States and we'll focus on the graph on the lower side, where the picture is quite encouraging and it beats most investor expectations. Despite several headwinds, including higher tariffs, introduction of higher tariffs, restrictive immigration policies, and then some political uncertainties within some periods, US GDP growth still remained resilient. And if you look in the chart, you can see that it was largely driven by strong consumption and then also business investments, particularly in AI and technology-led areas. That supported largely the growth. There was some negative contraction in the residential investment sector, but the stronger growth we saw in consumption and business investment largely offsets that. So, I mean, in all, the key message here is growth across major regions have been uneven, but we can see that there is also display of resilience here. US continues to be driven by innovation and consumption. Emerging markets are benefiting from local consumption resilience. And then in Europe, we see there's some stability, but also some structural risk. Having looked at this, we'll move on to the next slide, where we see how inflation has also fared across these regions. Inflation is very key because it affects asset valuation or prices, interest rates, and then also how economies do well. The good news here is across board, we see that inflation across major regions is easing. However, the pace of the ease and the factors that are driving the slowdown in inflation differ across, these regions. To start with, I'll talk about the Euro area, where we see clearly in the chart that inflation is, declining. We ended last year with an inflation print of 1.9% in December against a high of 2.5% somewhere in January. And what actually drove this performance is we saw energy prices declining. There was ease in service inflation and then softer wage growth also. In the US, the picture is quite a mixed one. We closed last year with a print of 2.7 against somewhere in March where we recorded a print of 2.4. And that was, a modest increase. If you look at the chart, you'll see that service inflation has remained sticky. Goods is making improvements and declining. And so this kind of raised some concerns whether the higher tariffs is having an effect on inflation and passing through. But the good news also here is despite inflation rising modestly, this has largely been in line with most investor expectations. And so it didn't raise or cause adverse market reaction that much. With having looked at inflation, we would also take the key message here, which is we know inflation is slowing down, but it's not collapsing entirely. This also gives room that going forward, central banks will be able to manage and inflation will not be controlled or determined by supply shocks. I'll move on to this next slide, which talks about how most central banks have dealt with the ease in inflation or how most central banks have reacted. And in the United States, last year we saw there were some Fed rate cuts. And this was largely to support growth and also keep inflation under check, but not because the economy is weak. If you move on to the Euro area, you would also see that the European Central Bank has kept the policy rate stable for some time. And this is to ensure that they support growth whilst keeping also inflation under check. Now, with all these in context, having looked at the fact that GDP growth has been strong and resilient across major regions, inflation is easing, and central bank is also cutting rates, you can see that these factors support financial markets. And we'll move on to the next slide where we look at how the equities markets in specific has reacted to these positive factors from the economic backdrop. The chart here represents the price return for the S&P 500, and we can see some indications here. At the beginning of the year, we saw significant pullbacks. The first one was fears around AI bubble, which triggered some tech sell-off. That was actually factored or caused by the DeepSeek issue, where most people or investors felt that the investments in AI were overvalued. And so markets reacted marginally to that. The most significant pullback we saw in the year was when the Trump administration announced that the new tariff regime, and that also caused a significant sell-off. Markets pulled back around 20%, and but we can also see in the graph that there was a quick recovery. There was also the Israel strike on Iran, and most investors felt that this would have actually filtered through and caused fuel price increase or energy price increases, which resultantly would have resulted in higher inflation, but that also did not materialize. But generally, we saw that markets recovered quickly and markets, moved upwards. So people who stayed invested benefited much. I'll move on to the next slide where we look at returns across some major indices that we track. And we can see clearly here across all the equity indices from the S&P to emerging markets area, in Q1, returns were quite weak, negative in the developed markets, positive in the emerging markets area, but that wasn't even a significant one. But from the second quarter to the fourth quarter and full year overall, we saw that performance was strong and positive. And so people who stayed invested again, this is how the major indices reflected, these performances. The next slide talks about the fixed income market and how the major indices also performed. The first quarter and across all the subsequent quarters recorded positive performance. And in the full year, we saw that fixed income, especially in the emerging markets area, performed quite strongly. We noted that across both asset classes, that's the equities and fixed income and other asset classes, there was positive performance across board. This is one of the first times we are seeing such a performance or positive performance across major asset classes. And so it's good to always stay invested. I'll end my presentation here and hand over to Peter, who would give us more on the outlook and what to expect in 2026.
Thank you, Gideon. And thank you to all of our participants for spending part of your morning with us. We really appreciate your time and trusting us with your assets as stewards. So I'm going to go over a quick review of 2025, what transpired. We saw inflation being stable throughout the year, between 2.5% and 2.8%. That was really, really good. We don't have the high inflation we had a few years ago after the pandemic. We saw strong market performance with S&P returning over 16%, emerging markets returning over 34%, and developed markets over 32%. So that was really, really strong as well. Coming into 2025, we were not sure how the market was going to perform. The biggest difference was the first time in a long time, emerging markets and developed international outperformed the US. But the markets were really, really strong. GDP growth was very, very strong as well. We saw US, overall annual GDP was around 3%. Q3 alone, showed growth of 4.3, which was revised higher last week to 4.4%. We're still waiting for the Q4 numbers to come out. But GDP for the largest economy in the world to be growing above 3%, that is indicative of a strong economy, and there's no recession on the horizon anytime soon. We also saw interest rates continue to trend down with the Fed cutting twice. Last year, interest rates came down to around 3.25 to 3.5%, which is good for the market. Another strong indicator of the 2025 returns was the strong corporate earnings. So almost 81% of S&P components beat forecasts. And so earnings continues to grow. This is as of Q3. We're still going through the Q4 earnings as the companies continue to report, but we expect that same strong performance to continue for the Q4 numbers as well. We saw unemployment creep higher slightly, which was not too good. It went from 4.2 beginning of the year to around 4.4. It's still contained below the 5%, target. My unemployment creeped up slightly, so that's something to keep an eye on. And then the trade and tariff uncertainties that we foresaw coming into 2025 as the biggest risk also played out as we saw with the Liberation Day rhetoric and also how the markets reacted, having a bit of a correction in April last year. So that's a snapshot or a quick review of the year 2025. Next slide, please. So with everything that transpired, we saw various asset classes perform differently. So like I said earlier on, emerging markets and developed international beat the US. So the best performing asset class was the EM equity, followed by developed markets equity before the S&P 500. Commodities was somewhere in the middle, and the worst performing asset class for last year was REITs. Next slide, please. So this slide also kind of corroborates the previous one. The only difference is it also has just the Q4 numbers, which showed a very strong showing by commodities. But emerging markets was the overall best performer for the year. Next slide, please. Now looking at what sectors actually helped, with the performance for last year in the US market. So the top best sectors for the year were communication services, technology, industrials, and also utilities. So those were the main sectors that drove most of the outperformance, and that's indicative of the markets, starting to broaden out. So whereas 2-3 years ago, most of the performance were all coming from tech and comm services, about 80%. Last year, we saw that broadening out to other sectors as well. So we saw industrials participating in their performance and also financials. And so that's really good for the markets overall. We also saw that the worst performing sector last year was real estate. Also, consumer staples and discretionary didn't do too well, and also energy. If you look in the middle of this particular graph, where it talks about valuations, you can see that S&P currently appears overvalued versus this historical average. And so it's something to be aware of and something to be wary of. This chart also shows which sectors are currently undervalued, where we see a lot of opportunities going forward. And so compared to the historical, PEs, we see that the most undervalued sectors are utilities, real estate, and energy. Utilities is one area that we really, really like. And so being undervalued, does provide a lot of investment opportunities going forward. Next slide, please. So with 2025 behind us, we want to look at where we are in this current cycle and then what that, portends for the coming year. So as of now, what the macro backdrop looks like is First of all, we're still in a very, very stable inflation environment. So we don't have, hyperinflation like we had during the pandemic or even right after the pandemic, where we saw supply chain issues drive inflation really high and energy prices went through the roof. Now inflation is stable. However, the biggest component of inflation now is shelter, which doesn't go down that easily, and that's why it's been sticky within the 2.5 to 3% range. But inflation is going to continue to be stable. We see central banks, around the globe currently in an easing cycle, and so that's really good for the markets. We also continue to see strong GDP growth in this current environment, which is also a positive for the market. The Trump administration, it's doesn't like a lot of regulations, and so we're going to see deregulation continue in this particular environment, and that's good for the financial services sector, also good for the energy space and other allied sectors. So we think that deregulation is going to boost a lot of market activities, and that's also a positive for the markets. We also continue to see strong corporate earnings. We're still waiting for Q4 earnings to come out. But so far, companies that have reported have mostly beaten expectations, which is also a very strong indicator of a strong economy. However, the trade and tariff uncertainties, continue to persist. And that's the environment that we continue to live in. However, with all that, Trump's rhetoric has been so far, Wall Street has coined a term called taco trade, which simply translates to Trump always chickens out. So the markets have perceived that Trump uses a lot of the tariff and trade rhetoric as bargaining chips, to negotiate for concessions. He will stake out a position to the extreme and eventually kind of move, in the middle or, be a no deal at all. So the volatility that is created by some of these uncertainties within the trade and tariff policies, actually presents buying opportunities and investing opportunities for asset classes that we really like. The geopolitical uncertainties continue to persist, and we started this year. We already have the Ukraine-Russia, issue still playing out. We've had Iran and Israel, having some skirmishes recently. But beginning of the year, we saw the invasion into Venezuela. There's talks about regime change in Cuba and also Mexico to some extent. Obviously, Trump also talked about Greenland, which was a major topic of last 2 weeks. And the biggest headline going into the World Economic Forum at Davos. But now that seems to be on the back burner at this point. So all that being said, geopolitical uncertainties persist, and that is never going to go away. So as risk managers, we need to be aware, with all that, so we can build portfolios that will endure, throughout those cycles. Next slide, please. So we're going to go over a quick snapshot of the US markets in particular. And then before we go into what sectors we like and which ones we don't like, what the investment opportunities are. So we already mentioned how, valuations are stretched in the US. So one negative of the US market currently is sky high valuations. And so we're in a situation where due to valuations, when there's any volatility, companies that are overvalued are going to pull back the most. We're not in a situation where a rising tide is going to lift all boats. You have to be selective as to what companies you want to invest in, and that's where active management comes in. We also have what we call the Warren Buffett indicator. It's currently very, very elevated. So that indicator simply, according to Warren Buffett, it simply says that you compare the market cap of the S&P 500 with the GDP of the US, economy. And if it's between, 80 to 120%, then the markets are fairly valued. We are currently around 200% of the GDP of the US economy. And that shows, very, very high, valuations of the markets in general. So that's something to be aware of. And then another negative coming to this year is the volatility that could arise from the midterm election coming up, in 2026. And so there's going to be a lot of political rhetoric, political campaigning, and that is likely to result some volatility. also creating investing opportunities for patient investors. Now, the positives in the current environment include a muted post-correction decline. So usually, if history is anything to go by, when we have a major pullback like we had last year of about 20%, subsequent declines thereafter are not as severe. And so we think that even if there's any major event that leads to a market pullback, it's not going to be as severe as what we saw last year. Also, the fourth year of a bull market is typically a positive year. And so this is with the fourth year of the current bull market. We had over 20% returns for both 2023 and 2024. Last year, the market returned just about 16%. So we may not have another strong, 16 or 20% return this year, but we think that we're going to have a double-digit, return this year. Next slide, please. Oh, and the last point is that the second year of a Fed rate cut also has historically been positive. And so since the Fed started cutting last year, this will be the second year. And we think that we're likely to see positive market reaction due to that, phenomenon as well. Next slide, please. So where do we see the investing opportunities? We still like the US market in spite of the, high valuation. The US continues to be the strongest economy, still growing around about 3%. We seen strong corporate earnings coming out. The Fed is in an easing cycle. Inflation is stable. We see consumers in a very strong position, and those are all positive indicators for investing in the US. However, like I mentioned, valuation concerns is huge, and so that's something to be aware of as a risk manager. We also see the midterm elections, potentially leading to some volatility. The positive aspect of the midterm elections is that it could result in a flip of one or both of the houses of Congress. And that's usually good for the government. Good for the economy. When we have divided government, it's usually good for the markets in general, because policies that are passed with during certain times usually require consensus from both sides of the aisle. And so those are usually more, sticky policies that will stay, versus when you have, a red wave or a blue wave, then they seem to go, either way, very extreme. And so those policies are usually not very popular. And so having a divided government could be good for the market. We also seen opportunities in developed international, that includes, developed parts of Europe and also Japan. Part of the result of all the rhetoric from the Trump administration has led to increased defense spending and also infrastructure spending in developed markets. Germany has increased their defense, budgets. They've increased infrastructure spending as well, and that's also leading to opportunities in industrials and other sectors within that space. Developed international also has really, really attractive valuations compared to the US. They are not as overvalued as the US markets are. So you can buy assets actually on the cheap, versus the US, economy. We see stable inflation within that part of the world as well. And their central banks have already been easing, even before the US started easing. The only two caveats or potential problems with that part of the world is their demographics are not very, very good. They have an aging population. And so there's not a whole lot of long-term opportunities as far as consumer spending goes. And then the trade and tariff uncertainties from the Trump administration, could also lead to some volatility in that part of the world. With emerging markets, we continue to like emerging markets really, really well. We think that this year is going to be another strong year for emerging markets. And some of the factors, that is going to lead to that is the reshoring theme and the infrastructure build out. So post-COVID, a lot of economies have been working to diversify away from China. So whereas for the last 4 or 5 decades, China has been the manufacturing hub of the world, during COVID, due to lockdowns and supply chain issues, a lot of other countries that were dependent on China could not get access to a lot of the components they needed, to continue to feed their factories and other sectors of the economies. And so coming out of COVID, a lot of companies, a lot of economies have diversified away from China, trying to bring manufacturing back to their shores. And so that's led to opportunities in parts of the world like Brazil, Mexico, India has been the biggest beneficiary. Even some US companies like Apple are building huge manufacturing hubs in India to feed, their manufacturing processes. And so we see a lot of opportunities in that theme continuing to go, going forward. We also see more favorable demographics in the emerging markets region due to the younger population compared to developed international. Emerging markets also has really very, very attractive valuations compared to the US markets, and so that also offers a lot of opportunities. However, there continues to be geopolitical tensions. That's something to be aware of as we invest in that area. And also the Trump, trade and tariff uncertainties, usually creates some volatility there, although we think that eventually they all, are used as bargaining chips or negotiating tactics. And so patient investors, will eventually make a nice, decent return by investing in that part of the world. Next slide, please. So with all that being said, how does this translate into, what sectors we like and what areas we don't like? So on the tactical level, the areas that we continue to like in this current environment going into 2026 is that we still like communication services. Communication services is going to do well in this environment due to the ongoing shift to digital ad spend, across the globe. How many times do we see commercials on our phones? Any website you go to, there's always, some kind of ads. Sometimes these ads are tailored, to your individual preferences and choices. So that is going to continue and making that particular sector very attractive. We also have two major sporting events coming up this year. So the Winter Olympics and the World Cup, both are going to lead to a lot of digital ad spend. The midterm election cycle is one of them as well. That's going to lead to a lot of, ad spend and then AI monetization. We also like financial services space due to interest rates continuing to go low. That is good for banks. Banks usually are able to lend, more because of the spread when rates are lower. We also going to see, or we expect to see, a lot of M&A activities due to deregulation by the Trump administration, and so that's also good for financials. We like tech space, obviously. We still, in the early innings of this whole AI phenomenon. And then so the AI infrastructure build out is going to continue. The AI spend is increasing, every year, and we do like the tech space, due to that. So we have, the chip manufacturers, we have the data centers that are being built, we have the equipment, makers that supply these chip manufacturers. We also like cybersecurity as another subsector that is going to continue to grow, and that all makes information technology one of the areas that we like. And then the next sector that we like really well is industrials. And so, like I mentioned earlier on, increased defense spending is going to, show up this sector very well. And then the whole reshoring and industrialization, also data center build outs, around the globe, and that all makes industrials another favorite sector to be invested in. The consumer discretionary and utility sectors we like, but we're not going to be overweight in this particular environment. We like utilities because it's one of the next iterations of this whole AI phenomenon, because the demand for energy and energy spent by the tech and AI companies is through the roof, and so there's not enough energy to supply for these data centers. And so they're going to continue to build different, sources of energy. They talk about, nuclear and other renewable sources of energy that's going to augment, the current supplies. And that also offers long-term, demand and long-term opportunities in investing in the energy space. Sectors that we're going to be underweight include materials and real estate. And real estate continues to struggle due to commercial real estate, having a major pullback. Last year, it's been about 3 years of a downtrend, and that's impacting that whole space. We think that the recovery is not currently in sight for that sector. Next slide, please. So that brings me to the end of my portion. Really, really appreciate your time, and we're open for Q&A at this time. Thank you. Over to you, Opari.
Thank you very much, Peter. Please stay with me. I will be taking a few questions before you take a breather. So, thank you very much once again for joining us for today. We hope you are enjoying the discussion. As mentioned earlier, please keep the questions coming as we start off with what we have already received. So, Peter, a quick one. During the presentation, you mentioned a Liberation Day event, and maybe for the benefit of those that may not be familiar or may have forgotten, it was in 2025 when we saw the barrage of tariffs from as high as 10% to as extreme as 60% across major trading partners. So the question we are receiving is that in 2026, are there key global events or personalities that are likely to shape investment market in 2026? If you can please take that for us, Peter.
Sure. Thank you, Opari. So obviously we don't have, the biggest crystal ball to, tell what's going to happen this year. But one major event that we need to be looking out for is how the midterm elections in the US is going to play out. If that, goes the way history has, shown, it's likely that Trump is going to lose his majority in Congress, and that is going to lead to a lot of consensus building, and that can impact a lot of the policies that he's been, kind of pursuing in this second administration. So that's something that may change the trajectory of the global economy. So that's a big one to look out for. The midterm elections could be huge. So having the possibility of, the majority in both the House and Senate flipping back to the Democrats will be a huge event that will, result in this whole immigration crackdown, obviously, having to be worked out differently. And then we'll also have some of the tariffs uncertainty, kind of lessened. So that's the biggest one I can tell, going to 2026 at this point.
Thank you. Thank you, Peter. Two more questions before you take a break. There's a question on emerging market. You mentioned how we are excited about emerging markets. So someone wants to know that looking at the performance and the fact that we're excited about it, should the percentage of emerging market in the portfolio be increased?
Yes, so that's something that we started working on that actually last year. And so we increased
Okay.
our emerging markets allocation middle of last year because we saw the opportunities, that were coming up, and we plan to increase it even further this year. So those were some of the moves that helped our portfolios outperform the US markets, last year. And so we do agree we want to increase our allocation to the emerging markets. The biggest challenge with emerging markets is that you have to be on the ground to actually know which companies, to own. And so we take our time to look for the right opportunities to invest there, but we want to increase our allocation there this year. So I agree with that thought process.
Thank you. Quick one. On your comment about the midterm, somebody would like to know if that's going to be positive for us as investors or negative.
Sure. So midterm elections usually, if history is anything to go by, it's usually led to a divided government for the most
Okay.
part. And so last year we had what we call a red wave, where Republicans won, both the White House and the two houses of Congress, okay, Senate and the House of Representatives. And so that was a red wave. And usually when we have a red wave or a blue wave, then the parties go to the extreme in implementing policies that only favor their constituents. However, when there's a divided government, they have to build a consensus. You have to work with the opposite party. And so that usually leads to policies that are actually good for the overall economy and actually are more sticky. And so typically, if you look, at various cycles, the markets have performed best when there's a there's a divided government. And so we think that if there's a flip in one of the houses to the Democrats, it's likely to result in a stronger economy and a stronger market. So that's going to be good for investors. That's
Sure.
my perspective.
Thank you, Peter. One last question before I move on to Eric. You also mentioned that the S&P 500 is overvalued, and there's a question that does it mean that we need to pull back on investment into such indexes?
So there's two parts to that answer. First of all, yes, so the S&P in general is overvalued, but not every sector in the S&P has participated in the recent uptrend. So after COVID, we saw the Mark 7, driving about 80% of the returns. 2023, 2024, that was the story. Last year, we saw that kind of changing a little bit. So the Mark 7 only accounted for about 42 to 50% of the market returns. We saw other sectors like industrials and financials and also utilities also having very, very strong returns. So there's pockets of the market that are not as overvalued. There are pockets of the market that are very, very undervalued. And that's where we are seeing opportunities. So we are reducing our allocation to the areas that are overvalued and then looking for opportunities to buy areas that are undervalued. We're also shifting some of our allocation out of the US to other parts of the world, like emerging markets and developed international, where the valuations are more attractive. And so I just want to say that I want to end by saying with an overvalued, markets, we're not going to see a situation where a rising tide is going to lift all boats. When there's volatility, the biggest equities to pull back will be those that are overvalued. And so that shows why active investing is needed. That's why you need an advisor to make some of these, allocations for you where we can drill down to look for what opportunities are. And so we do believe that active management is the way to go in this particular environment. And so pulling back is not necessarily the answer, but where you are invested in is what matters in this environment.
Thank you very much, Peter, for taking time to answer for us. You can take a break and grab a bottle of water. I'll get back to you shortly whilst I share a few questions with Eric. So, Eric, quick one. Someone would like to know what principles should guide an investor. Peter mentioned that that's why it's important to speak to an advisor before you make a decision. So, what should guide investors seeking sustainable success in the global markets, Eric?
Thank you very much, Opari. That's a very interesting one. So let me just share a few principles that should guide investors looking at investing globally. So when it comes to global investing, having a long-term perspective is key. And another principle you'd have to have the back of your mind is diversification. And then you also have to be disciplined and patient, and of regular review and rebalancing. When I say long-term perspective, successful investors think in years and decades, not days or months. You need to understand that wealth compounds over time, and you need to resist the temptation to chase short-term gains or panic during temporary downturns. So staying invested has proven to be a very important principle to guide anyone who wants to venture into this, go into this venture or global investing. Diversification, we always say only free lunch. Basically, spreading investments across different asset classes, geographies, sectors, investment styles, and this is a very important. How do I put it? A risk mitigation measure. So for every proper portfolio, diversification is key. No single investment should have the power to significantly damage your overall portfolio, no matter how good that investment is. So diversification is really important. Now, on the issue of discipline and patience, you need to follow your investment plan or your investment thesis. During bullish markets, when market is euphoric and market is rallying, that does not mean that you should throw away your investment thesis and stuff like that. Emotional decisions drive fear or greed. And Warren Buffett has a very classical quotation where he talks about the fact that you need to be fearful when others are greedy and greedy when others are fearful. So when markets are euphoric, you need to be very careful. You need to stay grounded. You need to stay disciplined and patient. The other point I mentioned was the fact that a regular review and rebalancing periodic, this is an active investors market. So it's very important to be reviewing your portfolio constantly to ensure that it aligns with your goals and your risk tolerance levels. So this is a very important point, and because with time markets keep changing, the markets are not static, the market's very dynamic. So it's very important that you pay close attention to your portfolios and ensure that you review it regularly and ensure that it's properly rebalanced to align with your goals.
Thank you. Thank you, Eric. So, thank you for that. We have a question here. Somebody would like to know what specific activities Access Wealth undertake to position our portfolios to perform well, and how the services of Access Wealth management compares to other investment options, similar investment options that exist in our markets. If you can also answer that for us, Eric. Thank you.
All right, so let me take your first question in terms of what specific things we do to ensure that your portfolios perform well. And in my previous response, I mentioned that this is an active investors market. So the main thing we do, continuous monitoring and researching and periodic rebalancing, so that at every point in time, we ensure that your portfolios are aligned with your goals and your current portfolio reflects current market conditions. In as much as we have our investment thesis, it's not, there again, it's not a static market. So continuous monitoring, continuous researching, and even having engagements like this to ensure that, at every point in time, we have the best of portfolios and we have portfolios that are resistant to various market conditions. On your second question, in terms of what differentiates our products from other products there, I mean, there's a very difficult one, but I mean, you rarely have any financial product on our market that give investors the level of flexibility that we currently offer to our clients, because it's highly personalized at the client level. And the power basically lies with the client. So we have extensive engagements. We have the ability to customize our portfolios to suit our clients. So at this point in time, it will be difficult to compare to any other product that there is. But the main point is that it's extremely personalized and is very flexible.
Thank you very much, Eric, for that. So you heard it from Eric and from all of us. It is extremely difficult to find something to compare with what you have with us at Access. Gideon, that's Mr. Gideon Amweniche, will also be taking a few questions for us. The first one is on gold. So somebody would like to know that although gold is doing so well, I see in your portfolio mix recommendation for clients seems to be relatively low on gold. Any reasons for that? And what is the outlook for gold investments this year? So, Gideon.
Okay, thank you very much, Opare. And before I touch on the gold, I would want to quickly add on to Eric's answer to how unique our service is. I think in our market here, our focus is to make financial planning our key pillar. Most investors don't actually use proper structured financial plan to achieve their investment objectives. And so we want to make that the core of our service, where we make sure that every client of ours has a properly and a well-structured financial plan which will clearly label out how he or she is going to achieve his investment objective. And so we have a dedicated software and a team which actually specializes in building financial plan for a client. Actually, if you don't do a financial plan, or we don't do one for you, it will be hard for us to take you on as a client. And so that's what we provide all our clients. Also, we absolutely lose global securities in executing clients' financial instructions. And so it's a direct access to global securities, which we provide clients, where we make sure that you are well custodied in the US and have direct access to markets. You have full transparency on everything that occurs on your account. And all this is being done at a very low fee. And so I don't think what we offer here, you would get it at any other place. Now, on the gold, we focus primarily on the traditional asset classes for the long term. Gold has primarily been a safe haven asset class, and so we usually resort to it when we feel that risk of sentiments in areas where we invest are heightened, and that's when we resort to gold. And so yes, it's strange that now you find the traditional asset classes doing well, and then gold is also doing well. It should have actually been historically the negative correlation, where you find traditional asset classes doing well and gold probably pulling back. And then when there's flight to safety, you find demand for gold increase. But that question has become essential, because now it looks like gold is moving along with the traditional asset classes. So we like gold, and it's something we actually have a little exposure to our clients' portfolios. It's an area we monitor actively, and we also like. So we have a bit of exposure there, but it's not to drive return. The main focus there is not to drive returns of clients' assets. We want to focus on the traditional asset classes to do that. So that would be my answer. So yes, we like gold. It's part of our areas where we focus on, but it's more, gold has been more of a safe haven asset, not to drive returns for clients, but to provide a hedge.
So Gideon, the next question is on digital currencies. You mentioned that we like gold. Do we like digital currencies? What investment prospect do they offer in 2026? Thank you. If you can also answer that for us.
Okay. So yes, digital currencies is virtually becoming part of us. If you read around, you see, and even in Ghana here, there's been wide adoption by most central banks, and the focus is to try and create a regulatory framework and environment for it, to make sure that it's well structured and clients' interests are protected when they are investing in those asset classes. For now, even though there's wide adoption ongoing, it hasn't become as widely accepted as the traditional asset classes. So it's an area where we are still building expertise. I think the Bitcoin has become the gold of the digital currencies. And so I know people have exposures there, but it's not an area where we have built expertise where we can say that we have a clear outlook. It's a very volatile asset class, which we are still monitoring, but people usually would, get exposure to, broad-based digital currencies through ETFs. And so alternatives are doing well. And so an exposure to that, based on your advisor's recommendation or advice, it can actually be adopted also.
Thank you, Gideon. You mentioned that alternatives are doing well. Someone would like to know how investors should think about alternative investment, especially in the current environment, and if you would like to share any light on similar alternative investment apart from maybe the digital currencies, Gideon.
Okay, so I think commodities are doing well. Gold, we all know and follow, but there's also silver and there's copper, which have actually outperformed gold. If you look at the return profile for last year, there's also some interest in rare earth minerals, which I mean are also doing well because of the interest in AI infrastructure. These are some, areas or alternative areas where we have seen that there has been some interest. However, as I indicated, the alternative sector has been historically more of a hedge provider than return addition. If you look at the outlook that is provided, gold is still expected to do well. The rare earth and other commodities are also expected, to do well. But I think to give the advice that people should invest in them, I think it should be based on your interaction with your advisor to actually firm up to know that, it fits well into your investment objectives and will actually help you achieve them. So, there are areas where projections are indicating that these alternatives are expected to do well, but we should also note that they are quite volatile, and so your overall investment objective should be considered.
Thank you. Thank you very much, Gideon. You can take a breather whilst I go to Eric and then back to Peter. So, Eric, there's a question on investment and mortgages. So this is the direct question. With my funds being invested, is it more prudent to take a mortgage loan or draw down to a property? What do you have to say about that, Eric?
Well, there's no straightforward answer to that, but then what it is that this depends on a lot of factors. But in a case where your portfolio is churning out returns greater than the interest on the mortgages, it makes a whole lot of sense to hold on to those positions and take in the mortgage. But sometimes it also depends on your situation. If you have about a short time to retirement or your income is not guaranteed and you have very good investment positions or you have some chunk of money into investment, it sometimes might make a bit of sense to do a huge payouts to reduce the mortgage amounts and all that. So you can apply the mixed approach. Alternatively, if your investments are turning very good returns, it makes a whole lot of sense not to, cash them out, but then take the mortgage to help you. But my main point here will be that it will be good to have a one-on-one conversation and we'll look at your current financial situation and do the relative analysis and come out with a very purposeful answer for you. Yeah.
Thank you. Thank you very much for that. We'll go back to Peter, who has a lot of questions here. I'll start with the first one. So Peter, so the preamble, I'll read the preamble. Market watchers are concerned that excessive spending by AI companies in data centers, mainly financed through bond issuance, has elevated the risk of underperformance, cascading into deeper market crises that can affect both equity and bond markets. I'd like to know your thoughts on the likelihood on whether we are likely to have an AI bubble and its contagion effect across the main asset classes. Peter.
Sure. Thank you for the question, Opari. So yes, it's very possible to have a bubble if, the markets keep going up due to expected earnings which don't materialize. It's very, very possible. However, if we compare the current market P to what, previous bubbles have had as far as the PE ratios back then. So in the tech bubble, for instance, the PE overall market PE was around 40, 45. Whereas now, we say the market is overvalued, but S&P is currently at 22. So even though it's higher than its historical average of 18, it's overvalued, but it's not as rich as it was during the previous bubbles. So what we as market participants continue to look at is, are these AI-related companies actually delivering, the returns? So far, NVIDIA has been the poster child of this whole AI phenomenon. And every single quarter over the last 2 years, at least 2 to 3 years, they have beaten expectations and their earnings continues to grow. So the demand is there. We are still in the very, very early innings of AI. And so I talked about how the chip, manufacturers are the first, opportunities within that space. There's also the next iteration is the companies that are building the data centers and running and managing them to house this whole AI infrastructure. So we are also investing in that part of the markets that's more industrials than just chip manufacturers. There's the third iteration, which is the energy demand, supply of energy to power these data centers and this whole AI, phenomenon. That's also another area. That's not going to be chip manufacturers, but it's utility providers. And then the fourth iteration we're looking at is companies and sectors that are actually incorporating AI into their processes to drive efficiency and drive, stronger returns. So if you look at it from that perspective, there's a whole lot of opportunities, going forward that we've not even scratched the surface of. By the time we actually see, most, sectors in the economy actually incorporating AI to drive efficiency and productivity, I think that's, another, generation, ahead of us. And so, yes, we may have a bubble sometime in the future, but it will be hard to predict when that bubble is going to happen. What we know now is that a lot of these companies are actually making record profits. The investments and spending into the AI, infrastructure continues to, go up. And the investment opportunities that we have now are being supported by the earnings and quarterly results that we are seeing with these companies. And so the opportunities are now, but long term, obviously, we'll get to a point where that phenomenon may be slowing down. But for now, I say that the bubble is nowhere close at this point. Thank you.
Peter, I related one on the US market being overvalued together with the AI wave. Someone would like to know if we should look at US valuations differently.
So that is a very, very hard question to answer. So how do you value a company? If you want to get into the nitty-gritty of valuation, it'll be hard to cover that on a platform like this. Also, depending on what sectors and what industry you're looking at, the valuation metrics will be different. There's so many ways to value companies. You value a dividend company different from how you value a growth company. If a company is actually continuing to grow and they're not paying out any dividends, you have to look at their, recent historical growth rate and how it's going to continue to grow in the future in order to value that company. You also have to look at what interest rates are. If interest rates are low, that usually leads to higher valuations. Interest rates have been coming down. So, there's so many ways to value a company, but so the valuation for the overall market is based on different factors. And as to how to change it, I don't know what other alternatives that you have in mind, but that's something that we can discuss at another forum. But for now, I think that evaluation metrics being used in the US, makes a lot of sense. Obviously, you have to look at each situation differently. And you have to, we believe in not just looking at the valuation, but we're also looking at long-term trends, what the future, value of the company is going to be versus what the current price is, and look for some kind of buffer. And so even if it pulls back, we'll still have some cushion to hedge us from any, a strong negative return. So there's a lot of ways to look at it, and there's no, one cup, fitting all when it comes to valuation. So that's how I will answer that question.
Thank you, Peter. I have another question for you on the US market. But before that, if you want, or Peter mentioned that if you need to support, if you need support with the financial plan, or you want to invest or explore investment in offshore opportunities, we encourage you to speak to any of us advisors. Email aptl@accesspension.com, or on a phone line, dedicated phone line 026 3015 323. It's all in the chat box, so you can note it somewhere so that after the engagement or the webinar, you call us and we can sit with you to have an extensive session with you before you take any decision to make your investment. So, Peter, back to you on the question. So, still on the American market, you did say that in your presentation, the developed international market have attractive valuations as well as stable inflation. So, the question is American exceptionalism still valid investment thesis in today's global market?
Very, very good question. So the way we look at it is what has made the US, the go-to investment destination for most investors. The US has always been a nation of immigrants. They've been able to attract talent from all over the world to build their economy. And that is what has made the US very attractive. They've created an enabling environment where no matter where you're coming from, as long as you have talent, you have skill, and you have good work ethic, you want to work hard, they will push you to be your best. Now, that has made US what it is, up until now. Now it looks like there's a bit of, a change in that dynamic with the new administration's policies, trying to restrict immigration and being selective as to who is allowed to come into the country. So if that trend continues long term, then that historical nature of the US is likely to change and may not be as attractive to a lot of talent as it has been in the past. And so that will eventually, kind of challenge that exceptionalism that they've enjoyed over the last few, over a century or so, at least since, World War One. But as of now, I will still say that the US still has, some of the most talented, people. It still has the strongest economy. It still has the largest, companies, even though a lot of the S&P 500 companies we get their revenue outside of the US. So about 42% of revenue for S&P 500 is outside of the US. And so even though the companies are domiciled there, they still derive a lot of revenue from outside of the US. Now, if these big companies, a lot of these tech companies, for instance, were founded by, people with immigrant backgrounds or people that migrated, to the US from other parts of the world, and they've been able to found these companies. Now, if long term such talented people are not allowed to go, to the US, then the rest of the world will have to be able to create, similar enabling environments to retain their talents to build up, such companies. That's the only way long term that exceptionalism, that the US has enjoyed is going to be challenged. But until then, it's hard to see how we're gonna be able to have another economy long term that's going to challenge, what the US, provides for the rest of the world. If the Trump administration's policies, hopefully this is a blip in the long-term trajectory where, after Trump is possibly out of the scene, the previous trend will get back on track. But if that continues long term, then that will be a problem. But until then, the US continues to be, the go-to destination. That would be my answer.
Thank you. Thank you very much, Peter. I'll allow you to take a breather whilst I go back to Eric. So, Eric, somebody has a question. I want to go on retirement and let my money work for me. What is your advice on this? Thank you.
That's a very interesting question, and that's financial freedom, and I guess that's the ultimate financial destination for everyone. So my recommendation would be that reach out to us, let's have this conversation, and I'm sure we will be able to come up with some tailored financial solutions for you in terms of investment. Having your money work for you obviously tells me that you've been able to substantially amount some interesting amounts that you want to put into the markets to generate sustainable returns for you to take care of your lifestyle going forward. So it's a very important thing, and we are very happy to have this conversation with you and assist you and do that with you. So after the webinar, we'll reach out to you and engage you and ensure that your dream of becoming financially free comes to fruition.
Thank you, Eric. Indeed, financial independence is the goal. I would still encourage you to visit our website to learn more about the wealth management offerings from Access Wealth Management. You can speak to an advisor or a financial planner by sending us an email, info@accesswealthmgt.com is in the chat box. And you can also call our dedicated line 026 301 5323. Our website is accesswealthmgt.com. And back to you, Gideon, on a few questions. So first of all, earlier you mentioned or you made a comment about the currency performance. So somebody would like to know. Sorry about the feedback. I think okay, thank you. So somebody would like to know what the outlook for major currencies and how should the currency risk be managed, seeing how Ghanaian funds that were dollar diversified took a big hit in 2025. Thank you.
Okay, thank you very much, Opare. So I would reference the USD to represent, most trading currencies. And the outlook for me, I expect the USD to continue or remain stable, but we should expect some slight tilt towards the USD weakening. And the factors that are going to be primary drivers of the direction of the USD will be dependent on the pace of Fed rate cuts, or whether even how interest rates, move, whether they cut rates and it falls below investors' expectation. That would mean that the USD returns will not be attractive to investors anymore. They might be looking for elsewhere to invest. The other thing would be risk of sentiments from geopolitics when people feel that US is no longer a safe haven. I think one thing that has driven the strength of the USD has been its safe haven nature. And so once risks of sentiments are heightened, that should mean the USD is likely to weaken. And then lastly, how growth pans out against other regions, relative growth. If we see or there's expectation of a recession on the horizon, that would also lead to investors fleeing the US market and leading to the USD weakening. But I think overall, we should see more stability. US has quite deep markets, like Peter referenced. And so now that inflation is quite or declining across all regions, when we are also seeing most central bank cutting rates, and then also the fact that USD, the US continues to represent dominant trade and currency, we should see more stability going forward.
Thank you, Gideon. Before you go, how should, and this is the next question, how should investors balance opportunities in Ghana with global investment in the current cycle? It looks like today's discussion, we've spoken a lot about global investment, but how should investors balance opportunities with Ghana and then global investment? Thank you.
Okay, so this brings up the issue of diversification.
Yeah.
Investors should always make sure that their portfolios are well diversified in terms of regions or geographic areas, or in terms of even currency. So I believe most people definitely have investments in or investment portfolios in Ghana. So an addition or adding on a USD investment portfolio also diversifies your portfolio. So diversification is very key here. Always make sure that whatever risk you are seeing, you diversify your portfolio against that.
Thank you, Gideon, on the fact that diversification is the magic in investment. So I'll be going back to Peter, but before Peter, Eric, there's a question here for you. I would like to enroll on your wealth management service. How do I join? And what's the process to fund my account? Eric, if you can please handle that.
Thank you very much, Opari, for that. It's a very simple process. There will be an initial intake meeting with an advisor. During this meeting, normally we have like a session where we do a fact find and we do also administer a risk profiling questionnaire. The fact finding will help us work with you to create a personalized financial plan, and the risk profiling will help us to set your risk levels. So when it comes to in terms of advice, in terms of investments and all that, we are well prepared to give you an optimal investment that suits your various risk appetite. The next phase would involve the advisor handholding you through the KYC process. It's a very stringent process, but we take, not to sugarcoat this for anyone, but we take up all the heavy liftings anyway on the KYC process. Then we also help you through the anti-money laundering screenings because the global markets are very strict with some of these things. After that, then you are all set and ready to fund your account. At this stage, we will still work closely with you and your various relationship managers in your banks to ensure that all the requested documentation you need to fund your account is put in place. And so it's once again, I'll say it's highly personalized, and it's something that we help you throughout the entire process to make sure that you have a very wonderful experience.
Thank you, Eric, for taking us through. Again, we'd like to remind you that you can give us a call on 026-301-5323 or send us an email, accesswealthmgt.com, or visit our website to learn more about our offerings. And like Eric said, it's so personalized. So reach out to us and we'll sit with you and make sure that you are set before we begin the entire journey with you. Now back to Peter, where maybe I'll take your last questions. Now, the first one is how should investors balance long-term and medium-term wealth creation strategies? How should investors balance long-term and medium-term wealth creation strategies? Thank you.
Thank you for the question, Apari. So, with the reason why we do financial planning as part of our wealth management offering is we believe in goals-based planning. So most, clients will have multiple goals, financial goals that they want to achieve. Obviously, top one will be retirement. Everybody wants to retire, financially independent at some point. And so that will be the priority. But between now and retirement, there will be other goals such as sending your kids to college. So college education, funding will be one goal. Another goal will be buying a house. Another goal could be, taking a family vacation. So we do our best to go through all the goals that the clients have. So long-term, medium-term, and short-term goals, and allocate your portfolios in that order. And so we may have, different accounts for the different goals, or we may have it all in one account, but have different asset classes to match, those goals. So what I will say is, in order to achieve both short-term and long-term goals, it's important to like map out those goals, have timelines to it, and allocate resources according to all those goals. But before you do all that, it's also important to have some kind of emergency, funds on the side in case there's any unforeseen circumstances that will require some expenditure that you didn't expect. Obviously, you want to, have that on the side so that you don't actually touch any of your investment, portfolios. But if you don't have any emergency funds set aside and something happens unexpectedly, that's when, you'll be tempted to dip into your investment portfolio. So as long as you have some kind of emergency there, and will help you to, go through your budget so that we can make sure that you really, spending way below your means and use the excess or extra, funds available to plan for the financial, future. But that's how we will assist a client to be able to meet both, short-term and long-term goals. I hope that answers the question.
Thank you, Peter. Two more questions for you. Um, so the comment starts with great discussion so far. I'm enjoying it. I think when you cut through the noise, no 47 policies would rather entrench US exceptionalism. Sorry, Peter, any comment on this?
I believe that comment is saying number 47, referring to the
Oh,
Trump.
sorry. Sure,
Yeah.
sure,
So
sure.
Trump is, number 47. He came in as number 45. Biden was number 46, and Trump came back as 47. So 47% of the United States. And so I believe the point is that when you cut through all the noise, the policies from the Trump administration will actually entrench US exceptionalism,
Sure,
which agrees with what I said earlier on. Until there's a fundamental change, long term, and other parts of the world also build up the right environment for their talents, the US, socialism is going to continue. And so I agree with that thought process.
Great, great. So another one, given that midterm elections typically lead to more balanced policies and thus a more stable economic environment, how does this reflect on outlooks on commodities, especially precious metals like gold?
So that's a very, very good question, actually. So one of the things that, we were looking at last year was how sharply commodities, rose, especially gold. Um, and that was mostly due to not just, flight to quality, but the uncertainty surrounding the Trump administration and some of their policies. So whereas in the past, flight to quality has been, a lot of investors around the globe investing in US treasuries. It's now because of the rhetoric coming out of the administration, people don't want to buy treasuries. So they're actually going to buy gold. And we've seen major central banks also using gold to support their currencies. And so even though gold had a very, very strong rise last year, and we know a lot of market participants thought, it wasn't attractive to buy anymore, and that it had come to the end of its rise. We think that that is going to continue this year. We think that gold still has room to run because of some of the rhetoric coming out of the Trump administration. And so what I will say is with regards to this year and the midterm elections, until the elections are done and the results are out, and we see that there's a flip, I think that the markets are going to be concerned about the current administration and some of the rhetoric coming out of there. And we're going to continue to see commodities, move up. So gold is going to continue, the upward trend. It might not be as strong as last year, but as long as the uncertainties, persist with the US, and how it's negotiating with other parts of the world or as trading partners, we think that gold is going to continue to be a safe haven for most, investors around the world. And so until we see the midterm elections resulting in a sort of a divided government, gold is continuing to be a good asset class, to own in this environment. And then if we see the the elections flip, to the Democrat side, that may, taper a little bit. But for now, commodities are a good asset class to own. And so just something that I wanted to add to that point.
Thank you. Thank you very much on that. Now, the last question. Yeah, I think the last question. Are investment in US equity markets and instruments subject to US taxation laws? Peter, that's also for you, if you can also handle that for us.
So yes, and no. So the US, as long as you invest in the US, as an investor, depending on what kind of accounts you are investing or what kind of vehicle you're using, you may be subject to, taxes. So why do I say this? If you have some kind of retirement, account, that may not be subject to taxes right away until you actually start drawing in retirement. However, if it's a non-retirement account, which we call non-qualified account, you'll be subject to capital gains taxes if realize gains realize gains in general. However, if it's short term, that's less than 12 months, then the tax rates on realizing those gains will be higher. And if it's long term, that's anything beyond 12 months, then the taxes will be lower. And then you're also subject to taxes on dividends and interest. And so, yes, as long as you invest in the US, you're subject to those taxes. The only caveat I'll add to that is there's a lot of, tax treaties between the US and other parts of the world. I know Ghana has some kind of reciprocal arrangement with the US, and so whatever taxes you pay in the US will be offset by your taxes here in Ghana and vice versa. And then, you're not going to be ending up paying double taxation. You may also be able to get, some of your taxes back when you file taxes. But what I want to add to it is that we are not necessarily tax advisors. And so for a specific, tax situation, you may have to speak to a tax advisor to give you, more information pertaining to your particular situation. What we do as investments and wealth management, professionals is that we run or manage the accounts in a very tax efficient way. So we'll do our best to minimize your tax implications for any investments that you do. However, we don't provide, tax advice per se. So we'll have to refer you to like a tax expert to give you more detailed advice. Thank you.
Thank you, Peter. That was going to be the follow-up as to whether we can recommend a tax expert, and you have confirmed that. So thank you so much, Peter, for taking time to answer all the questions for us. Thank you, Gideon. Thank you, Eric, and thank you to the entire team. And the biggest thank you goes to you, participant, for making today's webinar a success. We are so grateful for having you join us. So that will be all for this morning's webinar. Please give us a minute to answer a form or to complete a form. It's a very, very short form so that we can take feedback from you to make the next one better. We encourage you once again to speak to our advisors so that your specific needs can be addressed. We also want to once again thank you and to remind you that we're not going to end here. You will be hearing from us again within the year with our subsequent webinar series. It's been very exciting sharing your morning with us, and we want to say a big thank you from all of us at Access Wealth Management. We say thank you. Do enjoy the rest of the day. You would hear from us somewhere in July for another edition of the webinar by Access Wealth Management. Once again, please don't forget that a form will appear on your screen as you exit so that you can answer that for us. Thank you so much, and do enjoy the rest of your day. Bye.